Well, we are close to the lowest point of the day, and that's not a great way to start the last 1 hour of trade over the weekend. But to an extent, you would argue that this should have been anticipated. We were stretched quite a bit. The global markets weren't quite doing as well. We charted out in the morning how Nifty's looked versus how some of the other global markets have looked. And in that sense, this 1% is acceptable before the weekend. Anyways, before the budget, there will be some bit of caution that would come in. This is what, 48 hours of trade before the budget. So in some sense, this is to be anticipated. It's not banks which have necessarily cracked as much. A lot of other sectors have. Just bring up the mid caps and the small caps very quickly before we get to the heat map and show you what's moving within the large cap space. A lot of pressure out there. Nearly 2% for the small caps. The mid caps will come up on your screen again, close to 2% as well. So it's not looked very happy, and the market breadth too has looked very, very wobbly. Now, okay, this is the market breadth, of course. This is, well, a very large yawning alligator mouth today. Nevertheless, let's get the heat map. A lot of red, very little green, as you would expect or suspect. Metals have taken it on the chin. Tata Steel, JSW, Hindalco, and commodities by and large, because you look at a BPCL, ONGC, Coal India, yes, there is pressure here. We spoke about how oil upstream has run its first course, and I think today it's not about a call on oil upstream. Everything has come off, but oil upstream too, which has looked very strong until recently, has come off in the session today. A lot of red otherwise, very little green, with Infi being a bit of a lone ranger in the top four. LTI Mindtree and HCL Tech are very, very flattish. Frankly, there's almost nothing else but for Infosys, which has looked in the green. But Hersh, terrible market breadth, and that's the picture really, because we now had 2 days of mid caps and small caps having a very stiff correction relative to the large caps.
Well, absolutely, you said it, Niraj. The breadth is extremely stiff. You're looking at just about 18 advances on the Nifty mid-cap 150 versus 132 declines. So clearly the bears have it, at least in trade today. In terms of what's really standing out, let's pull up something like a persistent down 6.5% on the back of numbers. You're also seeing JSL, which is down roughly 6.5 again, and you're seeing KEI and some of the wire stocks also under pressure. If you can pull up a Polycab, that too is down 4% plus in trade. So some bit of pressure coming in. Of course, international business as well as margins seem to be slightly on the lower side when it comes to Polycab, and that trickling down to probably KEI as well. Let's pull up some of the gainers though, and I want to flag a couple of them off. Paytm up 4.5% on the back of numbers. The numbers maybe not great, but largely in line with what the street was expecting. And currently, it seems that anything that's in line when it comes to Paytm or average also will see some bit of reaction on the stock positive. AIA Engineering on the back of that initiating coverage note by BNP Paribas, up 2+%, just about 1.5% now in trade. So a bit of a cool off that we've seen on that particular counter. So those were the top gainers. Let me pull up some on the Nifty small cap as well. Chennai Petro, the big loser, 11% plus lower. We're also seeing MRPL down roughly 5.5%. Suven Pharma also seeing around 5% or so of declines. In terms of sectoral heat map and indices, well, the Nifty IT completely giving up all its gains now, trading absolutely flat. You're seeing the Nifty PSU Bank as well as the Nifty Bank down around 0.6% or thereabouts. The Nifty Auto down 2%. The Nifty Metal down 3.5+%. So that's where a lot of the pain is. 2.5% down on realty as well as energy. So that's the texture just in terms of how we are standing on the sector side of things. Let me welcome quickly on board Vaishali Parekh, Prabhudas Leeladhar, as well as Aditya Shah, Hercules Advisors, to talk to us about markets. Vaishali, let me come to you first with regard to the technicals. First off, what's the sense? Where does the market go going forward next week, critical week with regard to the budget? How are you reading trends?
Very good afternoon, all of you. Yes, market is seeing some tension, and of course, we have been witnessing exhaustion right from morning because we opened strong, but we did not sustain at all. So right now, once if we see a break of 24,500, it could trigger further selling pressure going towards maybe 24,000 levels to start with. And likewise, even Bank Nifty, what I'm talking about is, well, if 52,000 levels break, there could be a further selling.
Okay, Vaishali, just in terms of your take with regard to the budget, how would you play it now? We're into the last leg of the budget trade.
Well, right now there isn't much scope, but I would say partial profit booking should not be ruled out because we are seeing the mid-cap, small-cap index totally getting into selling pressure. So I would say a little bit of stay aside.
Okay. Aditya, is this the market or select portions of the market taking some money off the table ahead of the big event, or this would have happened independent of the budget, the correction today?
Niraj, the market was really very overheated, and I expected the market to correct because the market cannot have a one-way leg up. It will create a froth in the market where everybody will start to invest at any valuation. So this is a healthy correction. Maybe the budget was around the corner. That was a trigger. So as I've already been saying that there's a little bit of tulip mania getting created within the railway stock, within the defense stock, in the green energy stock, and to some extent the data centers as well. So a little bit of correction is healthy, and I will not rule out at least 5 to 10% correction, so which will be really very healthy for the market, and I'll be really happy if that happens.
Okay, really happy, and that's the interesting piece. You can attribute, Hersh, this to a pre-budget pullback as well, and some of it could have happened because a lot of people who made money, before the big budget or before the big event. So maybe the budget is the trigger for people to pull money off the table and just enjoy the weekend.
Yeah, it seems like, and probably it's also that there was some bit of anticipation that post the budget there may be some bit of profit booking, which has now been preponed a little bit because everyone's probably anticipating it, and maybe it's also that. But Vaishali, let me not guess. Let me come to your picks. Last 1 hour of trade this week.
Well, I would give one sell, that is Canfin Homes. That's showing some signs of weakness. So 870 would act as a stop loss, and my target would be 820. And among the banking sector, it's ICICI, which is holding very well among all the choppiness. So I would say ICICI with a stop loss of 1200, target 1300.
All right, excellent. Good to see some bullishness in the midst of all of this. Thanks for that, Vaishali. But let me quickly go across stock of the day. Infosys stock has gained on the back of strong set of numbers. We have Rucha joining us with what worked for the IT giant as well as brokerage views. Rucha, take it away.
So Infosys reported stellar results, as we all know, beat on all the three fronts, revenue, margins, profits up. But let me talk to you about, and guidance also, like, yes, that is important stuff. The company has increased its CC revenue growth guidance for FY25 from about 1 to 3% of band to 3 to 4% of band, while maintaining the operating margin guidance at 20 to 22%. But let me talk to you about the con call highlights which the company gave yesterday. The company definitely is seeing early signs of improvement in the US BFSI space. Now, BFSI is the segment wherein most of the IT companies receive the highest revenues from, and this has been a little bit of weaker vertical over the past 4 quarters. Even for this quarter, TCS had a weaker growth in the BFSI segment, but early signs of improvement for Infosys in this segment. But talking about discretionary demand, which has been under pressure over the last few quarters, this continues to be under pressure, is what Infosys management states. And mind you, the uptick in guidance is partly attributable to the inorganic acquisition of Intech, is what the company mentioned. So though the stock is up around 4% in trade today and the ADR was up around 8% today, but the management still says that discretionary demand is under pressure and they are not seeing any transformational projects or easing of budget by the clients. This is what Infosys is saying. But let me have a quick look on what brokerages are also saying on on Infosys. Most of the brokerages are bullish on the stock with a buy rating or an overweight rating. However, CLSA is the only one which has a downside of around 1% on the stock. Now, let me talk to you about what CLSA is saying. Strong deal wins and in tech acquisition will lead the growth ahead, and early signs of margin improvement as well under the new CFO is expected. Jefferies, however, also believes that there are initial signs of BFSI, and this will also drive the growth in the second half of the year. However, discretionary demand is still under pressure. So the talk of the town around discretionary still remains, Niraj. This is what we have on IT sector as a whole.
All right, thanks for that, Rucha. Aditya, I know you are a bit constructive on IT. Talk us through that thesis, if at all, that still continues to stand. And also, just with regard to valuations, because we've seen a bottoming of the cycle likely, but we've seen a run up in valuations which has been far faster. So just talk us through valuations and what your sense is with regard to demand.
So I'm constructive on IT. My thesis is absolutely very clear. This year will be softish for all mid-cap and large-cap IT per se. We don't expect the interest rate cuts to materialize, and that will mean that the demand in US and Europe will continue to remain soft. Having said that, the valuations continue to remain extremely aggressive, especially in the mid-cap IT space where there is growth. We've seen companies trading at about 40, 50, 60 times multiple. So what you should be really doing is you should be creating a basket of large cap as well as mid cap IT companies. Within the large cap space, the number one pick for us would be an HCL Tech, where the dividend yield as well as there is a little bit of valuation comfort as you compare it with TCS or an Infosys. Number one HCL Tech, number two TCS, and number three will be Infosys. Within the mid cap IT space, valuations are expensive, but we like KPIT, somebody like a Tata Elxsi or a L&T Technology Services or L&T Infotech Mindtree. Having said that, only in 25 and 26 is when the cycle is going to turn for the IT companies, and then they are going to do really well. So somebody with a 2 to 3 year view only should be investing.
Aditya, what's the rationale of buying into a KPIT, for example? 70 times earnings, that is expensive.
So Niraj, there are services-based companies and there are product-based companies, and KPIT is one of the product-based companies which is supplying to driverless cars as well as artificial intelligence. The stock is really very expensive, but however, I don't expect the stock to come down unless and until the company encounters a severe problem, which I don't think is coming in the short term. So what you have to really do, the way around very, very expensive stocks, which are really very good, is to SIP them over a period of time, or a period of 6, 12, 24 months, and then see how it goes. However, I agree with your thesis that the valuation here within the mid-cap IT space continues to be very aggressive because the growth is a little bit higher than the large-cap IT space.
Okay. Yeah, I mean, no, just trying to understand why. And, Vaishali, just come in on this one, KPIT, because it hit an intraday high of 1906 or 1910. Since then, it's cooled off, but nowhere close to what some of the others have. What do you do with something like this?
So I would say right now, in a current scenario, it is in a very good trend, and we are just seeing a little minor consolidation. So as long as 1800 levels are intact, I think the stock is ready for a target of around 2000, 2100. So my view stays bullish because this has shown gradual upward move. This has not really been disturbed in spite of the time when IT index on the whole was showing so much of weakness. It has just gradually held on, and we are seeing gradual improvement. So I think for a long-term perspective, this should be a hold.
All right, Vaishali, before we slip into a break, any other stocks which you find interesting at this point in the IT space, and your take on Infosys, please?
So Infosys, I think the trading target has really been met with. We saw a very strong opening, and it did not sustain at those levels. But I would still say that, yes, IT sector on the whole has shown a lot of improvement. And even on a weekly chart, it has given a breakout. So that means it can go into a little bit of consolidation to a sideways move. But now this implies that at every dip, IT sector, I mean, good quality stocks like HCL Tech, whether it's a Birlasoft or Wipro, all these stocks look positive to me at this level. And I think this should be bought and accumulated for a longer period of time.
All right. Well, time to slip into a short break. We'll, of course, continue to have advice coming in from both Aditya as well as Vaishali. Stay tuned. More on the other side, as well as speaking about some earnings reactions. Stay tuned. Welcome back. You're watching India Market Close here on NDTV Profit. I want to quickly address the numbers flashing at the bottom of your screen. 16.8% in terms of margins for Ultratech. Revenues slightly below. I mean, just about 1% or 2%, not significantly below. But essentially, it's the margin number which is far below expectations. And the profit after tax, therefore, is well below expectations as well. So you're looking at PAT, which has come in just about the 1650 odd crore mark versus the 1820 crore mark, which at least our estimates were indicating it to be. So sharply lower. And the reaction on the stock, not significant, at least as of now. Also, just in terms of what to expect going into this earnings call for Ultratech, which will happen later today evening, just to try and understand how volume as well as value growth is happening within the cement industry. There's plenty happening in terms of pricing, not able to hike prices, and that's currently the problem with cement. Cement prices, in fact, down 3 to 4% sequentially. But margins really not picking up. We have Mihika joining us quickly with regard to the Q1 numbers. Mihika, what's your first take? Margin miss, what's your sense? Why is that happening?
Yes, so margin mix is mostly based on the cost efficiencies when you go to see. However, it's key to know that energy costs were lower by 17% on a year-on-year basis, mainly on the cost to reduce fuel costs. But raw material cost did rise 1% on a year-on-year basis, which was mainly attributable to the increase in the cost of fly ash as well as slag. A quick run through the numbers: revenues were up 1.87%. This was lower than the growth uptick in revenues expected as per Bloomberg estimates. EBITDA and barely any uptick at all, up 0.13%, and this is against the expectations of over a 10% EBITDA uptick as per Bloomberg consensus estimates earlier in the day. Margins did see contraction 36 basis points. Net profit was also fairly flat at 0.29%. When we talk about the kind of capacity additions, however, the company added 8.7 million tons per annum during the quarter. This was distributed across the nations, and work on the remaining locations as a part of the phase 2 of their 22.6 million ton per annum expansion announced back in June 2022 is in full swing according to the company. Commercial production from the new capacity is expected to go in a stream manner from FY25 as well as FY26, and with respect to the third phase of growth announced back in October 2023, major orders for the key technology suppliers required have been placed, and civil work has also been started at some locations. And when we talk about the business of Kesoram Industries, Ultratech grey cement capacity will start augmented to 199.6 million ton annum versus 150 million ton per annum during their last announcement after their India Cement's financial investment. And this Kesoram industry capacity will also include 5.4 million tons of overseas capacity, which also expands them from a more than domestic basis.
Okay, thanks for that, Mihika. Thanks for breaking that down. Couple of quick pointers here as well. Power fuel costs have come off for Ultratech, and the margin miss is despite power fuel costs coming lower. You're also seeing some bit of an increase in both the other expenses as well as cost of materials consumed, and that's probably what has weighed down on the margins. Aditya, if at all you've had a chance to look at Ultratech's numbers, your quick take on what the numbers look like and what they largely indicate for the cement space, if I may ask.
So yesterday, Dalmia Bharat also reported their numbers, and the numbers were not really great. It seems to me that within the entire cement space, they are not able to pass on the cost escalations per se. And Ultratech as well, there seems to be a margin miss as well. So we need to understand from the management what is the EBITDA per ton per se, and what really happened within the operational matrix of the company. However, longer term, I'm really positive on Ultratech. It is the market leader, and it is continuing to gain market share. And as we know the news about India Cements as well. So we need to see the details of the results before we can comment on it.
All right. Thanks for that, Aditya. Aditya, but overall cement, are you constructive or are you staying away?
No, I am constructive on cement. As we know, the government is pushing really hard on the infrastructure side of it, as well as the real estate recovery is also happening. So there are two ways to play the cement sector per se. One, you can buy the large cap cement players like Ultratech Cement, and then you can play the regional players like Dalmia Bharat per se, where they are strong, very strong in their own specific localities. For example, Dalmia Bharat is very strong in the eastern side of it. So I am positive within the infrastructure space on the cement players.
Got it. Okay. Thanks, Aditya, for that. Let me switch focus to Polycab. The stock, of course, a bit beaten in trade today, nearly 4% lower. But on the back of numbers, we spoke with Executive Director Gandharv Tongia, and here's what he had to say on the company's outlook for FY25 and what we can expect going forward.
Last time when we gave guidance, it was after fiscal 2021. In 21, our top line was around 9,000 crore rupees, and we embarked on a transformation project by the name of Project Leap. Under this particular project, the quantitative target is to get to 20,000 crore rupees of top line by fiscal 26. 3 years later, last fiscal 24, our top line was around 18,000 crore rupees. So in around 3 years, we have doubled our revenue from 9,000 to 18,000 crore rupees. In the current year, we will probably recalibrate our guidance because 20,000 crore rupees, we believe we should be able to either meet or beat our own expectations of fiscal 26.
All right. Vaishali, before I go on and try and address the fundamentals, some of the guidance is given there. Let me first try and understand the stock on charts because the stock has tanked nearly 10+% from its top, and that's not too long ago, less than a month back. How is Polycab looking on charts for you, and what's your sense now on this one?
We are seeing some profit booking, and as long as 6,100 for now is held on, there's not much to worry. But if 6,100 levels break, then it will call for further weakness, and that's how I would see. It's anyway showing some signs of exhaustion, but 6,100 can be taken as a crucial support.
Okay. Aditya, coming to you with regard to Polycab, margin decline largely led by the mix changing export versus domestic. What's your sense now with regard to Polycab? This sub 13% kind of margin, you heard the commentary also coming in. What's your sense? Because stock certainly isn't cheap.
So as I said, the stock is not really cheap, and we've also had some corporate governance issues that have come up within Polycab. So I will rather wait and watch. The FMEG space looks really very interesting because as the real estate space continues to recover, FMEG space is the one which is seeing the maximum traction. So Havells, KEI Industries, Polycab, all of these stocks are really very expensive to buy. So I will just monitor them. If 1 or 2 quarters of margin erosion continues, then the valuation could start to come down. So you need to be really very careful, observe these stocks for the next 1 or 2 quarters and then take a call.
Well, watchful on margins, especially when it comes to some of these FMEG stocks. Okay, another stock that's trading under some bit of pressure is Tata Communications. Stock is down roughly 4% or in fact just about 4%. After reporting Q1 numbers, we caught up with the CFO, Kabir Ahmed Shakir, on the quarter gone by, listening to his views.
Yeah, we're quite pleased with the good start of the year. Although topically you see a -1% growth if you strip off voice and subs. Our focus has always been on the data business. So the data business has grown, albeit slightly lesser than what we would have wanted. But I think it's a healthy start to the year. It's grown year on year at 20%, which is good, helped by of course M&A that we did last year. On profitability, I would say we're quite again happy. Last quarter we ended at 18.6. I would like to remind the viewers, our ambition has always been to operate in 23 to 25 range, which we have been doing until last year when we did 2 acquisitions, which were margin dilutive and pulled our numbers down. But we then also advised the market that it's our ambition to get these back. So you see the first quarter in the year. As we inch up the margins from 18.6 of Q4 of last year to 20% already this year. So I would say we are, on the right track. Growth is of course the focus, and both India and international. We maintained our stated position that we are a market leader in India, and we would like to cement that. There's a lot of headroom to grow in international markets. Acquisitions that happened in international markets, revenue synergies will also see through coming in international markets. So there's opportunity for us to grow in international markets too. But as far as I'm concerned, both are important, both India and international.
All right. Aditya, your take on Tata Communications, of course, the positive being that margins have started to inch back up as said or as guided by the management. What's your sense with regard to this particular counter, and how do you expect business to grow for this one? 20% plus top line, can they continue to do that?
Hersh, I don't track this stock, so will not be able to comment on this.
Sure. Vaishali, let me come to you with regard to this one on technicals. What's your sense? What should one do if one holds Polycab or positions in my apologies, Tata Communications at this point?
This is just one of the categories because of the result. But I think if 1750 levels break, then it's time to exit. But till then, I think it's in the positive territory, and well, it can act contrarian and go towards 2000 levels.
Okay, and you believe that that's likely, Vaishali?
Well, something has to move. So let's see. This can act as a defensive because all this while, when market was coming towards its high, we were banking on ITC. So ITC did its round. So let's see how Tata Com does.
But you seem bullish.
For now, it is.
Okay.
If 1750 levels break, then I would change my view.
Sure. Okay. Fine. So before we head into break, it's time for one of those again. The CII has put out its wish list for Budget 2024. It includes a wide range of reforms, including ease of doing business, tax reforms, and land and agriculture reforms as well. Sanjeev Puri, the president of CII, said that green shoots are visible in the rural economy. Listen in to a slice of that.
We are certainly seeing some green shoots, and I would say not just us. This is the commentary you've heard from several players in the industry. There are green shoots definitely, visible. But I think the question really to answer is that how do you put rural into a much stronger trajectory? And as I said earlier, the challenge has been on account of weather events. Fortunately, the monsoon, the predictions so far are good this year. So hopefully the crop should be better. That will provide some impetus to rural India. But on a sustained basis, I think the issue is about how do we build resilience in agriculture? How do we create more non-farm jobs in rural India?
All right, welcome back. Thanks for staying tuned to India Market Close here on NDTV Profit. One bunch of stocks which we'll continue to have our eyes on next week and likely might also get, a bit of less attention given the budget will likely be the pharma counters. You'll have a whole host of pharma stocks which will be in focus on the back of numbers. Aditya, just talk to us about how you're seeing the pharma sector, both as a turnaround. Is there some more time to go, especially on the chemical side of things? How is demand playing out in your view?
There are two aspects of it. One is the specialty chemicals and the chemical space, and one is the pharma space. So for the chemicals space, I don't see the recovery happening at least until the end of this year, and maybe next year we will see some green shoots for most of the chemical players per se. Having said that, about the pharma sector, on the pharma sector, we have already seen good green shoots for the API space, let's say for DV's labs, to some extent for Laurus labs, and also for Newland labs. We are seeing green shoots for the CRAM CDMO space as well, where Piramal Pharma has reported good set of numbers. Syngene is not pointing to a recovery. For them, the recovery will happen only at the end of this year. So what I'm trying to say here is pharma and chemicals are a very diverse space. You need to look at it company by company and subsector by subsector, and then go and invest there. We are positive both on the chemical space as well as the pharma space, and within the pharma space, the API space, the CRAM CDMO space, and the diagnostic space is something that looks really very interesting.
All right, that's on pharma, but we also have Agam standing by, as he mandatorily does at 3, to break down the FNOQs for today. Agam, what are the FNOQs indicating?
Actually, there is we're now starting to see some weakness coming through. Remember that yesterday the broader markets were already weak, but today we're also now starting to see your larger cap companies wilt under pressure. That explains the Nifty down by over 1%, now edging towards the mark of 24,500. And remember that until this morning, there was a chance that we could potentially see 25,000 on the cards. Not only has that been denied, but now it does seem like we are starting to test 24,500 on the lower end, where there was a little bit of support playing out at the moment. A lot of unwinding, perhaps on expected lines, because yesterday we saw longs building up. And it's even in terms of the bank Nifty, that's where we see the index come off by around 0.7%. Not too much change in open interest. But, coming down to your options market, and in terms of the range that we're expecting the Nifty to move within, it is exactly that 500-point range. And should we see the Nifty break 24,000 on the lower end on Monday, it most likely will not break it today. But if that does happen on Monday, then you never know how things could eventually pan out. But to talk about stocks, a lot of weakness across. In fact, there are very few gainers even on the Nifty 50. But shorts for Atul, Eicher Motors, MRF, Reliance Industries. Atul actually came up with a reasonably good set of numbers, but we are looking into selling perhaps about a profit taking there as well. Even among other stock counters, we're keeping an eye on something like Aarti Industries, Dalmia Bharat, where we are seeing long unwinding. Reliance Industries itself is down 2% ahead of its earnings. And as we move into Monday, that's the big number that we're going to keep an eye on that could potentially have more repercussions as far as the index is concerned. For now, the Nifty testing 24,500. Whether or not we expect more weakness, a little bit more nervousness in the run-up to the union budget, that's a wait and watch.
Thanks for that, Agam. Thanks for putting that into perspective. Meanwhile, BPCL numbers on the screen and below estimates, and as a result of which that stock too has taken a beating. Not that this result brought it down. I think the stock was anyways lower, but I think the result has only exacerbated the pressure on BPCL. 4.5% lower now for that stock. Well and truly below estimates, well and truly below what they did in the corresponding quarter last year on most counts, if not all. And as a result, that pressure is showing. For all the bad press that some of these stocks have gotten in the recent past with regards to how the stock prices have been very choppy and volatile, I've missed seeing any very large constructive buy calls on the oil marketing companies, not because of just crude moving up, but even otherwise. Far cry from what used to be maybe a year and a half ago, or maybe longer. What's the call on a BPCL, and especially after the numbers they have come out, 29% drop in profitability and about 10% lower than what was estimated any which ways?
So rather than looking at oil marketing companies, I really look at the gas distribution companies or the upstream gas companies as well. It's very clear that the government is not able to divest any of these oil marketing companies, which could have led to a big trigger and big re-rating into all of these three companies. So generally, we tend to avoid these companies because whenever there will be an election, let's say, for example, there is a Maharashtra election that is going to come up in December, these companies will not be able to raise prices in that specific area, and then there will be a problem for these companies. So generally, these companies will be an avoid, and the massive trigger for re-rating of these companies is if the government is able to successfully divest BPCL, which is a very, very good asset to have. But unfortunately, over the past 2 to 3 years, the government has not able to divest.
That's true. Okay. Well, it's 4.26% lower is BPCL. Vaishali, anything on the charts for a BPCL? Vaishali, can you hear me? Yeah, please continue.
Yes. So right now, BPCL, I mean, we have seen a good consolidation right now. So we need to wait and watch, because if 290 levels break, then I think it's heading for a corrective move. Till then, it's just a range-bound approach.
Yeah, 3 or 4 and counting. And Hersh, the recent upgrades that have come in as well, usually keep an HPCL or a BPCL into account, not as much IOC, and understandably so. But Aditya is right. I mean, if the divestment goes through, it's fine. But otherwise, these numbers don't inspire. I mean, they will, of course, change every quarter. So this quarter, EBITDA margin is 5% versus 8% otherwise on quarter-on-quarter basis. These numbers will change. But the street thus far, not taking the numbers too kindly.
Not at all, Niraj. But, I don't know, maybe slightly on the positive side, elections are now past us. It's time to possibly look ahead, look forward. And maybe from Q2 onwards, possibly pricing change should maybe help the numbers. No?
Could be. I mean, I don't know, because of the way the election verdict has been and because state elections being here, that's the other conundrum, if you will. But well, maybe Hersh makes a valid point too. The bigger one is out of the way. Who knows? Something may happen. But independent of that, which is open to interpretation, let's get in Mihika out to try and tell us what the numbers look like from BPCL. Mihika, disappointing quarter, I reckon. But what's gone wrong?
So mainly, let's just top up with the numbers. Net profit down 29% at 3,015 crores. Revenue saw 3% reduction at 1.13 lakh crores versus 1.16 lakh crores, and this is all on a quarter-on-quarter basis. EBITDA also saw a significant downtick at 39%, and this led to a margin contraction of over 300 basis points. Now, weaker results were expected on behalf of the companies, and that's expected across the board for OMCs, and the main reason are the gross refining margins. Now, what the entire weakness is coming, majority of the weakness is coming from the refining segment, as the gross refining margins for the company as well as the benchmark versus Singapore GRMs have contracted over the quarter, and this has signified a weakness in the refining segment of the Indian oil marketing companies. Furthermore, an expected impact of the ₹2 per litre price cut that took place for petrol and diesel in mid-March of this year itself. The impact of this price cut was also expected to kind of moderate the marketing margins from the highs that we've seen in the last 2 years. So these are the main highlights, and we'll get you more as we get more details.
Well, absolutely. Thanks for that, Mihika, for rounding that up. Of course, EBITDA declined quite steep, and therefore your profits are down nearly 30% on a sequential basis. But let's switch focus to the big boys. We have Reliance Industries set to announce numbers today. HDFC Bank set to announce numbers tomorrow. Let's start with Reliance. Of course, recent rate hikes, Jio also expected to perform better. Oil chemicals segments expected to see a weak quarter. That's largely the way one would look at Q1 FY25. Price hikes yet to take full center stage. Mihika, again, talk to us about what one can expect from these Q1 numbers from Reliance.
Yes, a weaker quarter is expected, and this mainly to the oil to chemical segment, as well as amount of slowdown expected in the retail segment. Now, when you look at the numbers on a consolidated Q-on-Q level, revenue is expected to drop almost 2%. Operating profit margins could fall around 15%, which would likely contract margins to around 280 basis points on a sequential basis. And in the end, net profit is likely to decline by 6.8% as per Bloomberg consensus estimates. Now, when we look at its segment segment-wise. First, let's go to the oil to chemicals. Now, businesses like to see a sharp earnings decline, and this is on back of lower gross refining margins, which is something that we saw in BPCL as well. They expect a $4.7 per barrel drop in the GRMs, but however, some losses could be offset by the higher volumes. As far as Reliance Jio, the segment is likely to perform better. Higher subscription addition is expected at 8 million as per ICICI Securities, and they also expect a 0.6% uptick in the average revenue per user at 182.7 rupees. And lastly, when we talk about the retail segment, a slowdown in business is expected to drag profits down by 1% on a Q-on-Q basis. However, when you look at the operating profits, this could see a 3% uptick to 6,000 crores.
Okay, that's Reliance and the big boy ahead of the numbers, looking a bit skittish in line with how the market largely has looked. Vaishali, is there a trade on Reliance Industries ahead of its results? Is it looking weak or is it looking close to supports?
Sorry, I would give it a miss. We normally don't play results, so I think it's better to avoid. Let's see how it performs and then we'll take a look.
Okay. What about upstream at large? Yesterday, Oil India was down 5. Today, ONGC is down about 3.5. Reliance, as you said, has looked weak too. What do you... And then there is Hindustan Oil Exploration, which for completely different reasons has had a phenomenal run in the last few days. Vaishali?
I would say when market gets into the corrective mode, I don't think there is any exception to it. So I would say that, yes, I mean, ONGC also, one way, after giving a breakout at 305 levels, it's performed so well. It's gone up to 330 plus. So I think this is a regular retracement. So I would say these stocks are quite strong for now. Even Oil India is also very strong. But let's wait it out. I mean, today is one such day where we are seeing absolute selling in mid-cap as well as the front line. So can't give a call on this.
All right. Thanks for that, Vaishali. Let me come to the other two, both HDFC as well as Kotak, big names expected to declare numbers. Well, HDFC, largely the focus will be on the margins. Expectations will come right up on your screen as we speak. Margin recovery, glide path, some visibility on that will be the key, as has been the commentary which came even in the annual report last evening. Also, with regard to replacement of borrowings with deposits, we had Shashidhar Jagdishan's comment on that as part of the annual report, and any kind of visibility on that. 21% borrowing, erstwhile HDFC Bank had just 8% borrowing. So as that unwind happens, and how quickly can that unwind happen, will be in focus. Growth concerns as to how long will growth remain muted for while this adjustment happens, as well as asset quality. That's largely going to be the expectation. It's asset quality expected to be very stable, but we've had a floating provision which was created in Q4. What does that do to the larger picture, and how does management view asset quality now at the backdrop of all of this is going to also hold some bit of an importance in the analyst community. Aditya, you track HDFC quite closely. Talk to us about what your expectations are and what do you make of the provisional numbers, because at least I have not had a chance to speak with you on the channel with regard to the provisional numbers. What's your sense? Very muted growth. How do you look at it now?
So Harsh, it is quite natural when the LDR is so high that the company will slow down its loan growth and try to concentrate on growing its deposit, and thereby after that it will again revert back to its 15 to 20% loan growth that we are so used to seeing. And that is exactly what Shashidhar Jagdishan was also showing, as you said in the annual report. Today, Mr. Shaktikanta Das, who is the governor of RBI, has also warned that there is a structural problem if deposits do not come into the banking system and go into the capital markets by the way of stocks going up. So the problem for HDFC Bank is right bang in the middle of the merger. There is a deposit slowdown, and because of that deposit slowdown, they are not able to accumulate deposit as fast as they had expected, which is leading to a massive erosion in the margins, where we have seen margins come down from 4% to about 3.4, 3.5%. And that's where we are. This quarter, the only concentration, in my opinion, should be on is the margin able to recover or not. If from 3.4, 3.5%, we are back up to 3.5, 3.6%, the market will take it really very positively and will bank on HDFC to recover its loan growth slow and steady. If the margin does not recover and it stays where it was, then we have a real problem that HDFC Bank will start to again underperform. So all eyes on the margins per se. All other factors are inconsequential in my opinion, because slippages anyway for all banks right now will be really very muted. Loan growth we've already seen is going to be muted because the LDR is really very high. So margins are the only one thing that we need to really concentrate on HDFC Bank this time around.
Okay, let's it's 3:20 that time of the day when we take closing strategies. So Vaishali, would love to come to you. I know it's a difficult one ahead of the budget, but if you had to do an STBT or a BTST at these rates, 10 minutes to close, what stock would you choose?
ICICI looks good. And
Vaishali, I lost you. Can you repeat the answer again, please?
ICICI among all the stocks still looks good. So that is one stock to my liking. And in cash category, there is one Navkar Corp, which is holding very well with good volume in spite of all the choppiness. So that is another stock to my liking.
Okay, holding out a couple of these names. Navkar Corp, interestingly, has made a seriously good move. ICICI Bank, second guest, another guest had spoken about the bandwagon of ICICI Bank in the session today as well. It's not done too much, but considering the circumstances, has fallen precious little. So that's to be kept in mind as well. But Hersh, ICICI Bank?
Actually, we've Kotak Bank's numbers coming out. So that one will also be in focus.
And HDFC Bank sometime?
Sometime tomorrow, both of them. Yes. So, but let's talk Kotak because we've spoken about HDFC. We're expecting to see likely at least the growth hold up for Kotak. We're expecting 16% growth on the advances side, muted 1% on a sequential basis, but nonetheless, it's also a softer quarter. So seasonality may also likely play out. Deposits, though, expected to go up by roughly 19% year over year. So that expected to remain healthy despite the RBI embargo. Not full quarter, but at least for part of the quarter. And therefore, you're expecting growth largely to be sustaining above the 15% kind of mark. That's the expectation. You're looking at net interest income, which is expected to go up 3% sequential, 14% year on year. Operating profit expected to be absolutely muted on the back of very strong OPEX, which the company will largely be expected to continue to churn out. Provisioning will spike up a little bit on a sequential basis off a low base, and profit after tax on a standalone basis is expected to be flat sequentially, or rather flat year on year and come off sequentially. Now, in terms of how much is the margin contraction, that will be the key question. We've built in a margin contraction of roughly 12 basis points. So from the 5.28% to the 5.16% odd, that's the expectation. We are expecting cost of funds to go up. Growth impact going forward on the RBI embargo will be a key to watch out for. What is that impact like, and what's the strategy going to be like going forward? They've had a good 3 months in terms of a thought as to what's going to play out, and cost and OPEX expected to continue to remain elevated, at least for the moment, and that probably weigh down on operating profit. Aditya, you want to weigh in on Kotak Bank because you track the banks quite closely.
Yes, again on Kotak Bank, they have got a specific problem themselves. Uday Kotak's boots are getting filled now, and we will need to see how the new management really lays down their strategy. That's the first point. Second point is we've already seen RBI create an embargo on the digital acquisition of customers. What Kotak Bank is really doing, what are the steps that they are really taking in order to comply with the RBI problems per se? That is something that is really very important. I don't think the results matter in Kotak's case too much. They need to come out of this embargo of RBI very quickly within the next 3 to 6 months. Otherwise, the stock will again see a time correction per se. So those are the two most important things, the new management as well as the technology embargo that the RBI has really put in. What are they going to do about it? Those two important things are something to really watch out
All right, Vaishali, Kotak on charts. We've seen a bit of a rally over the last couple of months or so. What's your sense with regard to this one? I know you like ICICI. You've reiterated that, but talk us through Kotak.
Even Kotak chartically looks quite all right. I mean, we can see some little bit of retracement. So for now, 1770, 1780 would act as a good support for a fresh buying strategy. And once we see the stock sustaining well above 1880 levels, I think it's ready for a further up move going towards 1950, 2000.
Okay. Not too many stocks that are even trying to do any kind of a bounce back, if you will. So that's to be borne in mind as well as we start wrapping up the trade. Aditya, I heard you say that it's a correction that you would be happy about, 5%, 10% as the case may be. What is the gunpowder kept dry for? I'm not saying what levels will you buy or what sector, but maybe some idea of a couple of things that you're watching out for, that if they fall quite a bit, then you might be comfortable buying.
Niraj, large private sector banks, as I have been continuously saying, they look really very interesting. Then again, on the chemical side of it, on the pharma side of it, companies look really very interesting per se. They have taken a massive hammering over the last 1.5, 2 years. API, CRAMS, CDMO, diagnostic space. Within the capital goods space, the road makers, the EPC makers, they look really very interesting. I will definitely stay out of the defense, railway counters. They need to see a massive correction to clear out the froth where people are, as you were saying that day, IREDA went from 200 to 300 within a couple of weeks. So there the froth needs to get cleared out. Once that froth is cleared out, then you can think about entering these stocks. However, do not speculate or gamble within the railway stocks, defense stocks, within the green energy space per se, and the data centers per se.
All right, thanks for that, Aditya. Vaishali, we've seen a bit of a slip or a further slip that we've seen on the benchmark itself. How would you play the trade next week, especially where the Nifty Bank are concerned? Talk to us.
I think now for the coming week, I would say 24,400. The near-term support lies over there. If we break those support levels, we are in for a good corrective move going first towards 24,000 and then perhaps even lower. So that's how I would be looking at the stock, Nifty. And well, stocks, not much to say right now.
Understandably so. Vaishali and Aditya, thank you so much for taking the time out and being with us and giving us your thoughts. Really appreciate your time. Have a great weekend. Let's start wrapping up the markets. And a somber state of affairs really today. We've made virtually no attempt to bounce, and it's been a trending day lower, and we're closing almost at the low point of the day or at the low point of the day. In fact, we should get the intraday of the Nifty because I think we are at the low point of the day today for the Nifty. 24530 or thereabouts right there. We are ending at the low point of the day. So trending day lower normally doesn't augur too well. But it's more painful at the broader end of the spectrum. So that's the second point to keep in mind. And then let's get the heat map up on the screen and just show you the quantum of pain. The mid caps, small caps, all of them ending close to the day's lows. A lot of red, very little green. In fact, Infosys is just up about 2%. The ADR was up 8%, and that's a very muted reaction to a good set of numbers. But I think the market falling under its own weight, stretched beyond a limit. Look at commodities and look how badly they have fallen in the session today. So Hersh, pain points all round today.
Absolutely. Let's pull up the sectoral indices and we'll try and zoom in on some of the pain points that we saw today. No gainers. We've seen the Nifty IT reverse that gain, but metal, PSU, energy, realty are probably the four places where there is pain. Among the larger ones, there's also auto, 2.5% lower. Let's pull up the Nifty metal because that one is absolutely beaten, 4% lower. Let's pull that up if we can in terms of constituents. And we did see both Tata Steel as well as some of the other, commodity on the Nifty 50, commodity names on the Nifty 50 take quite a beating. There you go, 5% lower on Tata Steel, but Jindal Stainless 6.5% lower. It's probably the second, third top loser on the Nifty mid cap. And you're seeing pain across the board, Hindalco, SAIL, as well as Hindustan Copper. The Nifty Energy, if we can, because we have the largest energy player, Reliance Industries, to come out with numbers. And you can see BPCL came out with numbers as well, down 4%. But otherwise, you're seeing pain across the board. Reliance closing the week at around 1.8% lower as we speak. That's where we've closed.
Just very quickly, the BSE 500 before we wrap up, and just that's the last chart that we'll show. And just to give you a sense of across the board what's corrected, even good numbers like Persistent got punished. Stocks like Cummins, ABB second day on a trot down in the session today. So that's the list of losers. Amber down 7%, Suven Pharma. Nothing was spared, Harsh.
Absolutely. Look at some of the gainers though, interesting ones. VST Industries flying away, 11.5% higher to close this week off. You have RVNL, which I'm not sure where this rally stops for some of these rail stocks. But of course, we have the budget coming up next week, and maybe some of those will be in focus. Infosys closing in 1.7% high, just 1.7%.
Just 1.7. But that's it on this leg of India Market Close. From Harsh, me and the team that put this show together, thanks so much for tuning in.
Welcome, you're watching NDTV Profit, and in our pre-budget series, we're speaking to a large number of thinkers on what we should really expect from this budget. And we honestly need to go beyond just the brass tacks. What will be the fiscal deficit? What kind of capex numbers? Which sectors really make the most out of it? And these are things, of course, that we track. We look at, how markets will respond, etc. But in terms of a policy roadmap, what does this budget need to do, and why is this budget so crucial to set the stage not only for this fiscal year but for the next 5 years? And who better to speak on this than Manish Sabharwal, Vice Chairman of Team Lee, is with us. I think one of India's foremost thinkers when it comes to the jobs and employment part of the puzzle, and that really is the big one. So, Mr.